Okay. What is going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to be doing some stock analysis for Mercado Libre stock. This is ticker MELI, and this is $105 billion market cap. They are an online e-commerce platform that operates in Brazil, Argentina, Mexico, and other countries. And this company has some very nice growth rates. As you can see here, the last 5 years, this stock has averaged 5% revenue growth. Or I'm sorry, the last 5 years, the stock has averaged 51% revenue growth, which is just incredible. Insane numbers there. The last 2 years, we've seen it slow down a little bit, but still 38% is awesome. Then we go to what analysts had them doing, and we're looking at, again, 37% this year, and then it's supposed to slow down to 28%, which that's something you have to keep in mind when you are valuing a stock and picking what price to sales or what price to earnings do I want to value this stock at? Because as soon as those growth rates stop accelerating and they come down like that, that multiple is going to drop drastically. So, for instance, here's the price to sales history. You know, as you can see here, I mean, this goes pretty far back to 2007, but we want to look in more recent times. In more recent times, this stock will trade what from a price to sales of a 9 up to like a 17, okay? And then the last, well, really, you could say the last 3 years, it's been more so around a 4 or a 5, okay? So a 4 or 5 is probably more realistic, and that's with them growing double what they're supposed to grow next year. So it could even drop down to like a 2, and that's what you have to be careful of. Is that's how, the stock could look like a good deal now, but if those earnings or those revenue numbers, the growth slows, those multiples will come down. And that's what you have to watch out for. So, but basically, the numbers look solid though. Revenue trend is looking solid. Net income has been solid too, but the last couple of quarters it's been flat. They're stuck at $2 billion in net income, which keep in mind, $2 billion in net income on a $100 billion valuation means you're paying 50 times earnings. And that's not a high growth stock. We're talking net income that's been flat for almost a year now, which typically, if your income is flat, you're looking at like a 15 price to earnings. So keep that in mind. Now, free cash flow has gotten a lot better. As you can see, that is on a much more stronger trend. They're doing $8 billion of free cash flow, which is incredible. That's a great number. So obviously, operating cash flow is going up or capex is coming down. Their cash to debt ratio is great. We're looking at almost 13 billion in cash and only three and a half, around $4 billion of debt. So those ratios are good. Shares outstanding, pretty much flat, nothing to worry about there. And most of the numbers look good here. Free cash flow yield of 7.5%, solid. Profit margin of 8%, solid. I definitely pay attention to things like, the last couple of years, what has this valuation traded at? So the fact that we've seen it come down to about a 4, right now it's cheap. Right now it's only a 4, but it could come down to a 3, right? And if it comes down to a 3, it doesn't sound like a lot, but 4 to 3 is a 25% drop. That could be a 25% drop in the stock just because of the multiple coming down. Not necessarily their revenue. The revenue could stay the same, but if it looks like if their guidance is projecting slower growth, that price of sales could go from a 4 to a 3. Next thing you know, the stock is down 25%. That's what you have to watch out for. Otherwise, if this stock keeps trading at 30 times earnings, 35 times earnings, then yeah, this stock could keep going up because look at what they were supposed to do for EPS next year. The EPS growth is insane, which honestly, that's more important than revenue. So you kind of want to give more importance to that. So the EPS is going from 37 to 40 to 62 supposedly next year. Right now, the stock is trading at 33. Well, see, we just did net income, though. You look at net income, and it's trading at, well, actually, I take that back. That's trailing times. That's trailing earnings. We're looking on a forward basis of 62. So let's see. So what's 44, or I'm sorry, 40 times 33 is 1,300. Yeah, so that's even for this year, the EPS and net income are not the same. Net income is so they must be. I'm not sure what's going on here because if they're trading at 50 times net income, but they're trading at, let's see, what is this? Let's see, 2000. divided by 40. They're okay. No, that's right. So they're trading at 50 times earnings right now. 50 times earnings is rich. I can almost promise you that's not going to last. I can almost promise that like let's say next year they do 62 times earnings, the stock's not going to be $3,100. I can unless you have some, artificial thing like GameStop or something where everybody piles up into the stock on most, on a realistic basis, the stock's not going to go over $3,000. It's not going to trade at 50 times earnings after they have this huge jump. And they let's say they do 60, let's say they grow up to 62 times or $62 EPS next year. And we're talking, growth is slowing now. It's going to be down to 30%, under 30%. It's not going to maintain that 50 times earnings. I don't think that's going to happen. I think you're going to see that start to condense more and more because then what's going to happen after 28% growth? Then they're going to report 20% growth, right? And I mean, go look at Amazon, Shopify, some of these other stocks that have traded at high multiples. Amazon for a while was trading at above 50 times earnings, but it doesn't now because the growth slowed. And I mean, that's Amazon. So just keep some of those things in mind. Otherwise, I like the stock. I like what I see here. I'm not going to pay a huge valuation, which when you look at the 5-year chart, it's underperformed the market by a lot. It's only up 45% in the last 5 years. That's a huge underperformance. And I think it's mostly because the stock was obviously overvalued back here in 2021 and then it crashed in 2022. And it's had a nice run the last couple years, but it's just not worth paying those sort of valuations for. So let's go over here now. Price to earnings growth. I like this one, 1.4. So again, compared to where it's been the last 5 years, the stock looks cheap. Forward PE of 30, when it's normally between a 35 to a 50, 30 looks pretty good. Trailing PE of 50 now, though. You're paying 50 times trailing earnings, but again, it normally is between a 50 and an 80. So 50 looks pretty cheap. But most stocks, pretty much every stock, will not maintain that valuation. It just won't. So I don't see this stock going over $3,000 next year because I don't see it maintaining a 50 times earnings. Um, Again though, I kind of want the stock. I kind of because the numbers are good. The valuation is down. Net income is supposed to have a EPS supposed to have a huge jump from 40 to 60. And free cash flow is looking solid. Cash to debt is looking solid. Shares outstanding is not a problem. So what else do we have here? Long-term commercial deal to sell Brazilian retailer products. Okay. Yeah, so I mean it's moving into these markets where, that's great and all. I don't know. I'm partly interested. I'm just not going to pay 34 times forward earnings. I would pay because you have to think what happens when all these companies slow down growth at some point. So when they slow down, what's going to happen to that stock? What happens when they report? What happens one day they're going to come out with earnings and there's going to be a report that says, "Yeah, we're lowering our guidance a little bit." Or actually, we're not growing 30 or 40% anymore. Now we're probably going to be closer to 15 or 20% or 23% or something. When those numbers get lower, that stock is not going to trade at 50 times earnings. It's going to come down to 30 and then 25. And then typically like 20 to 30 is where you're going to see it. It could stay there for a long time. But even upwards of 40, I would say once you get to 40 times earnings, you're pushing it. That it's hard to maintain that for more than a year or two. So I would say if they do 62 times now, they could also beat that. They could come in with 70 or something, right? If I want to pay 25 times, I would buy the stock for like 1500. That's kind of what I'm looking at. If this stock came down to 1500, I would be interested. That's the way I look at it. So I'm going to end it there. Let me know what your guys' thoughts is, and I will see you in the next video.